Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. Meet Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the powerful tools you and your organization need to trade and manage crypto at scale. Reliable, easy to integrate, with white glove service and 24/7 support. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payword Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. Welcome back to another episode of Forward Guidance, and joining me today is George Robertson of the Monetary Frontier. George, I'm really excited to get you on the show here to finally meet and chat. I've been a long time reader and listener of your views, and I appreciate that they're very contrarian and first principles based on your own analysis. So I'm really excited to have you on the show. We're going to spend the next hour or so just really digging deep on truly unpacking and understanding your theses that you have within the context that you have. So it's going to be a ton of fun. It's great to have you.
Okay, great. Very complimentary words, and I'm really pleased to be on the show. I know this is a new career for you, if you will, for the last 6 months, and you must be careful in terms of who you get on it. So I'm very complimented that you would have me on.
Awesome. Yeah, I think like I said, there's some contrarian and first principles views that are very interesting. So we're going to spend the next while here really unpacking that. So the first one, and it's the one that you've made some headlines about, which is this idea that the Fed doesn't exist, and on a headline basis that sounds quite confusing because we just had like the FOMC meeting yesterday, and there was a Fed chair, Jerome Powell exists as a person. So the idea that they don't exist, I feel like confuses a lot of people. So I really just want to boil down and unpack this understanding of what you mean when you say there's no Fed, and how do you actually analyze that?
I'm gonna backpedal just a little bit. When I say no Fed, I don't mean that there's not an $8 trillion balance sheet out there, and that there's not this incredible, powerful institution that's in charge of all the most of the system banks that has great suasion, great control, great strategy in terms of its effect on the U.S. economy. What I mean by no Fed is that there's no, for the last, I'd say 10 years, there's no discernible monetary policy that has effect in terms of either raising employment or dropping employment, to produce unemployment. There's no Fed in terms of an ease or a tightening, which will impact end GDP, and thereby, since the Fed can't just go and deem inflation, the only way it can get to inflation is it has to influence either employment or one and the same, the economy in general. And for about 10 years, and I sort of been dismayed about this because everything was just, not quite on autopilot, but if you had an understanding of that the Fed will raise unemployment or raise employment, employment, and if you knew the process on how they would do that, then you could actually, the Fed didn't even have to do it. They just had to nudge interest rates up a bit, like the Fed funds, and then nudge them down. And that was more than enough. So it was almost like the threat of the Fed doing what they have done in the past, which was sufficient. And that definitely was monetary policy. But from 2014 on, and I think a lot of this, if there's blame to be assigned, it comes from Bernanke and a certain crew that he hangs out with. Williams running the New York Fed right now, the San Francisco crowd. I think they're still entrenched in Chicago. Felt that we are in such a serious crisis with the GFC, I think that maybe that was warranted, that they could not apply normal monetary policy to assure that the banks would maintain existence. Some banks, and after shutting down what would have been a bank, Lehman, they then had Bear Stearns, so they had to cast away for what they felt was a wholly different way of managing the banking system, such that great instability wouldn't wreck the economy. Therefore, they sought and they implemented a really radical new monetary policy, and a thesis for the whole Fed, which is still to this day has surprised me that this isn't like front and central for everyone's discussion about the Fed. And that was the change to first Neil Wicksell. Neil Wicksell does not think that there's a dynamic neutral rate that can be up to 4 or down to 2, depending upon what the inflation and the employment is doing, but that it's a set rate that has stability and first existence, which will be a fulcrum point whereby if Fed funds are raised over the natural rate, then that will be an ease. And it doesn't matter what the hell's going on with anything else. If the natural rate is thought to be 2.5, say 2, even 2, then if we take Fed funds down to 1 or zero lower bound or even 0, then we have a 2% ease that's going on. And that's just, we can depend on that. So therefore, if we have an ease going on, we will put inflation up. It has been obvious that that didn't happen. That as the Fed dropped to,
Yeah, just to quickly unpack, when you say Neo Wicksell, and then you mentioned something that happened in 2014, I just want to clarify what you mean by that. So what your assertion is that in 2014, when Ben Bernanke was the Fed chair, there was a policy shift in terms of how they actually implemented monetary policy, and you're saying that shift is called Neo Wicksell, right?
That's correct, and it's admitted or not confessed. It's stated for clearly by the Fed that is what they did, and it has some complexity to it. The first appears was when Bernanke was giving a speech or chiding to Japan in front of the Bank of Japan or the Monetary Society or something of Tokyo in I think it was 2006 or so, and then it disappeared. And then when the GFC hit, Bernanke and a few others in the Fed resurrected it. Now, it was thought that this was since it was such a stunning radical change, they needed a way to implement this Neo Wicksell policy, this belief that there's a natural rate that has some permanence or stability, such that at any time in any way, Fed funds over that natural rate would be a tightening, and if Fed funds below that natural rate would be an ease, so that they could change Fed funds as per their concerns for the banking system or the economy. They no longer had to shock the economy by suddenly saying, like Volcker, ding, 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 we're
right.
Interest rates have just gone up 2 points, or do an ease that would go down 1-2 points. Now, the great moderation through Greenspan sort of took that off the table anyway. But when we had the GFC, the Fed once again became concerned. This says, hey, if we follow a rule-based system, well, first of all, we can't go through 0 now. Congress and the law won't allow us to go to 0. Like, even though some of the Scandies and central banks did go through 0, we're zero lower bound, and so if we don't have Fed funds as a responsive tool for the economy, what do? And then that's the second shoe, if you will, is that along with this Neo Wicksell idea of a natural rate, Michael Woodford of Columbia came out with his pretty stunning also spiel that he gave at Jackson Hole in 2012. It's a little dense. I don't know. It's like 93 pages, but you can just read the abstract of the first couple paragraphs and the conclusion, or you can read excellent commentary that's produced at the time. And what Woodford offered was that, well, it doesn't really matter that you can't go through zero. You can't get as much as you want below the natural rate in terms of an ease. What we can do is just convince the market that you are the Fed, you are all powerful, and just move the whole debate to, 3 months, 6 months, 1 year forward, such that when these bad times end, which they will, given any sort of governance, from the federal government, when we come back, the Fed will be there to catch the emerging Fed funds rate as per a rule, and they'll implement the rule thereafter, but now with this natural rate in mind. Well, they found that despite the fact that they could never raise inflation up toward 2%, nobody cared really that inflation was at 1%. And they also found that, and I think it was a political problem, is that Obama was pretty austere. Like a lot of people now say, "Oh, it was the Republicans. They wouldn't let him do anything he wanted to do, and he wanted to ease and everything." But he did. Krugman was sputteringly mad that the Obama plan was only about $50 billion a year in stimulus, and I think anybody with looking at what the GFC did thought, well, yeah, it needs at least 500 billion, if not a trillion. So, therefore, if the Fed were to follow the Fed funds once they emerged off of zero on any sort of rule based, then they would also highlight, if not augment, the austerity that Obama was applying to the economy, and then we'd get back into sort of a very slow economy, if not possibly a recession.
Yeah.
A lot of people talked about this as the secular stagnation. Summers was all about that. So they just kept it near zero lower bound. They didn't follow as Woodford prescribed. They did not follow Fed funds up on any sort of rule based. And in fact, when Yellen came into power or into the chair, she started to screw with the Taylor rule, saying, "Oh, well, it's not that. We do this, we do that," all sorts of magic recipes, so that the great difference between the Fed fund rate and the discount rate that the Fed was applying to the Taylor rule idea for that preceded for 30 years before this time wasn't noted, and times had changed. The neutral rate has gone up, or the secular stagnation. There's 101 excuses, but basically the Fed did not stop the Woodford type of forward guidance policy tool, and thereby because they thought this was a greater thing for stability, maybe it gave them more clout. It certainly made them command the press and the media and get everyone onto one page. It actually was by moving it all into forward space, they no longer had a Fed funds as the policy tool. Mm-hmm. Now, the problem with that is that there is only one policy tool really for the Fed. They made a lot of notion about QE and QT and some guys have picked up reverse repo and all these acronyms. But even the Fed said that QE and QT, either as the results or actually as the intent, was only reserve management. In other words, it was QE was meant to change reserves from like a very low single percentage point up to 30, 40% of the banks, and again, to make them more stable. So that being the case, the Fed basically threw out the window their only policy tool, which was Fed funds. You can like say conceptually, who are you? You're out to lunch. I think the whole might and fury of the Fed research, the Board of Governors Research Department, is against everything you say. So hell with you. We're going to carry on with this focus on Nick Tamiris coming out with the latest wisdom, which is fed to him by Michelle Smith. Now that this is a nice sidecar, but part of Woodford requires control of forward space in terms of expectations.
Mm-hmm. Otherwise known as just forward guidance.
Forward guidance, exactly.
Yeah.
And forward guidance isn't like, all things might happen, but this is likely where we end up. Forward guidance is actually an insistence that they will control the outcome. So they start to make careers. Young journalists at papers like the Wall Street Journal New York Times where they bypassed the old steady guys who might actually be critical of the Fed, and they went directly to these young characters, to these new guys, and they spoon fed them this forward guidance, and they're the first ones to get it. I don't know. They get midnight calls from Michelle Smith, sometimes even Bernanke, and he says so in his books. You get on the phone directly with those journalists who understood what the Fed was doing.
Right. Right.
Maybe some words out of whack, but it's very close to what he actually said.
Right.
What that all means is that Fed funds, no matter, as long as they keep inflation, well, not into deflation, but we can, we're ever approaching 2%, and we can keep this straight arm on the mem, on the narrative, and everyone's saying the same thing. That's great. It allows us a lot more time to go out and apply Dodd-Frank and strong arm recalcitrant banks and everything.
Yeah. So George, I just want to pause and try to summarize this timeline
Sure.
that you mentioned, and then let me know if I have it correct or not. So effectively, in the early 2010s, we were in an era of what you called secular stagnation due to there's the residual effects of the great financial crisis in terms of lending in the economy, but then also this form of fiscal austerity that was occurring. And so because of this, Fed funds was at 0% at the zero lower bound. They couldn't go negative. So then they introduced these new models that were you basically call the Wicksell Woodford model, which surmises that, in the absence of the ability to go negative, we need to come up with new tools so the first tool is forward guidance by, basically saying, we're going to keep zero for a long time. And then the second one being the installation of facilities like quantitative easing that we're going to try to convince the public that they have an effect. And by doing so, that's going to provide a further ease because we cannot go below zero. So that was happening at a time.
Oh, Felix, I should just have you do this,
Well, that's why I'm here. I'm trying to summarize and get your points across because they're very powerful thoughts, but people get confused. So effectively that happened. And then what was the change was that as the economy started to grow, it was time to get off the zero lower bound. But what you're saying is, for whatever reason, we kept this Woodford model of forward guidance and QE and facility reserve management for whatever reason. And so now we're in this weird era. So this was the original sin that caused this era of constant forward guidance and press conferences and everything, right?
Yes, absolutely. Well, very well said. And I appreciate your help because I feel at times I'm frustrated a little bit in terms of being able to communicate this clearly. Now, this was all fine. And then we had a brief incident when Trump won, strong-armed Powell to back off of trying to normalize Fed funds, because I think it's safe to say that Powell is a traditionalist. Or I don't think he's completely sold on all these Princeton guys and Harvard guys in Chicago telling them that you got to keep this Wicksell going. So he tried to raise Fed funds toward the norm, toward a rule-based system. And I think he tried to get away from the signals of QE and QT and all this hoopla and get back to what he would have known the Fed was in the 90s and the aughts before the GFC. I think his instincts were right. But then Trump just kiboshed him and said, basically, I read it and I don't think it's so cynical, was that if you want to be reappointed, you better drop rates. And so he said, I'm going to normalize and all in 2018. And in fact, he raised Fed funds another 25 basis points in December of 2018. But thereafter, he very quickly dropped rates so that by 2019, he was actually back to dropping Fed funds to well below any sort of rule-based. By that time, Trump was out of office, and then Yellen, as the new Treasury Secretary, is quite comfortable to be a good friend of the Fed as long as they weren't an issue. And from her point of view, that was to get back to the Woodford implementation, which is no longer concerned about zero rates or negative rates, but just get out of it, get out of the game,
right,
and just go manage J.P. Morgan's loan book, and hopefully you don't have a Silicon Valley, which they did anyway. Just become a non-issue so that we can go on with whatever Bidenomics was or is. this is all good, and but Biden broke the big rule, which is that the Democratic Party at at the federal level can never ease in terms of federal fiscal spend because most of the national spending on the private sector is organized usually with an affinity for the Republicans. That means that if I suddenly plunk in 2 trillion into the economy from fiscal spend, there's probably going to go to various entities and people that will use it to kibosh me. And I think that might be an explanation of actually what's happened with Trump's election.
Right.
So he forgot that, and although Trump, I think, thoughtfully, because he does have good advisors back at the end, but in his last year, he did start the fiscal spend to remedy COVID. But then Biden just says, whatever you can do, I can do better, and he just blew the lid off, so
Yeah.
that we ended up with a fiscal spend, of which we have not seen since World War II.
Mm-hmm.
Um,
Mm-hmm. And basically, what you're saying is, in the context of such huge fiscal spend, and maybe this would be a good time to get into the data of this assertion that there is no monetary policy because the original you know reaction function of monetary policy was based on like a Taylor rule type model where the Fed instantly reacts to the strength or weakness of the economy instead of guiding it. So I know you've done a lot of work to basically quantify this lack of a monetary policy because of this neo Wicksell Woodford model. So maybe we could just unpack the specifics around how you're seeing and analyzing empirically that there is no monetary policy, and then we could look at the implications of what that means in a highly high government expenditure type of economy that we're in today.
the starting point is, how does the Fed work? Well, there's only one policy tool. There's no QE, no QT in terms of like ease or tightening. There's just Fed funds. And the way Fed funds work is because the U.S. Is not in a perfectly rational idea of flexible prices. Like, in other words, prices don't immediately anticipate what the money would be, and the money here is really more of an indication of, uh, of GDP and the price level. If the Fed is at too much of an ease, either or allows the fiscal impulse to get too much of an ease, i.e., the federal spend, then money grows, the economy grows, and price level grows. And then that's just that you got to eat it. And perhaps this is a good way, a very rough cut way to explain what happened in the 70s, going into Volcker. But the reality is that it's sticky prices. That means that people overreact, if you will. So if the money goes up and the Fed responds, or doesn't respond, the price level goes up, and then output actually sinks. So that's stagflation. What Friedman offered to this was that, well, why don't we just simplify this and say money, in most cases, we've centered now on M2, money times velocity, and that's just how many times you got to multiply money to equal NGDP, equals the price level, inflation, times real. That's why GDP. So this means that if we just can control money in terms of tightening or loosening, we can avoid these two outcomes, and it's great. It's almost not quite autopilot, but if we have a good reaction function, a Taylor rule was where we ended up with. This works quite fine, and it's predictable. Everyone knows where the Fed is, what they're doing. The Fed can comment on fiscal policy, and everyone knows what's up. But the kicker to this is that velocity has to be stable. Like, we can't have velocity moving all over the place because it becomes a mess. And so velocity has not been steady. And the reason for this is because after with QEs, we've had just a tremendous drop in velocity from, it used to be
Right.
around 2 down to as low as 1.2 going into COVID.
Is that because during QE the swap that occurs is taking out a high velocity asset like a treasury security and swapping it for a central bank reserve that is very sticky and just stays on bank balance sheets?
Not really. It's more of the aggregation's wrong.
Ah,
That as money is always there. I mean, there always is a theoretically actual money that is turned over in terms of like transaction ability of the economy to equal NGDP. But what happened was with QE, they lost control of the definition of money and the velocity of M2. This because reserves are in money, it just dropped like a stone, so that they no longer could like say, okay, this week, obviously, based upon the H8 reports and other reports that we put out every week, it's clear that we're too loose or too tight. And anyway, they didn't have a reaction function anyway. Because if at the start of all this was, you can see that they started with some sort of control, but the Fed funds were buried at zero. So there was no way to discern what the Fed's policy stance would be, because it can't go from -3 to -2. It just stays at zero. So everything entered into a fog bank in terms of like a misunderstanding of what money is, and then it just plummeted with the final. This is the COVID QE, which sort of did the death knell in terms of understanding where money is. Nobody knew. Now, you can adjust this to some degree by this is the steadiness of money until we got to the QE ruckus. And you can see that the red line, which is just M2, including QE, which is reserves, it's just all over the map. And it soars, especially once we hit QVID. It was already trending at a much higher level that was not really reflecting the economy. So it really wasn't very useful. But then it just blew up when we got into COVID. It peaked up right hard toward the end of all the fiscal policies, and then it started to tighten up because I think the Fed tried to do some stuff, but generally useless. Now, if I take all the impact of QEs out of this monetary aggregate, I get a little bit of a better line, but it's still pretty jagged. And this is all the I don't know H15 H5. I'm sorry, I should know cold, but this is all off the weekly report. And then it has to be with the effect of Fed signaling QE.
mm-hmm.
I mean, they call it a signal.
Yeah.
It starts to get a little more usefulness, but it's still out of whack in terms of being able to be indicative of what the Fed's effect on the economy is. So it's not very useful. Furthermore, right about here, the Fed hides M2. It says we're not going to release this every week. What we're going to do is release it for a month forward of the prior month's weekly.
Right.
So we're only going to release it once a month. And so it's going to have a lag of 4 weeks. So that lag can grow to much greater than 4 weeks. So you have to adjust that and bring M2 forward as if they were timely releasing it. And the only way I could figure out how to do it, I use the Atlanta Fed's GDP Now as an indication of like, well, if the economy grew or declined, but basically always growing, then this is where M2 would be. And it's an assumption if the Fed was reporting it every week. And then even then, there's still heavy torquing that makes money useless. Okay, now, so what to do to understand the Fed policy? And again, I'm trying to prove that the Fed does have monetary policy. So it's sort of like the null set, if you will.
The null. Yep.
Yeah. So this is what I've reverted to, and great help from just a guy 5 times brighter than me who was associated with me, Riddick Goyle, was to start looking at not what they say they're doing or they're going to do, but let's just look at the one thing that they do have complete control over is the system banks, J.P. Morgan right down to the smallest. And this is, and I know this one. This is in the H8 weekly report of bank loans. This is the aggregation of all the bank loans the systems make, and this is the cumulative level it's just outstanding. So no need to adjust it to rolling annual or year over year. And you can see that we're starting to make sense. There's the hit from the GFC. The economy got stifled. There's definitely some encouragement of the banks to make money, and all this stuff ends up as money, right?
So this is commercial bank loan growth. Why does the Fed have complete control over it?
These are all I don't have S&Ls and various guys that are under the FDIC or private banking sector. I don't have shadow banks.
Okay.
This is just the system banks that due to regulations have to report and work with the Fed, and the Fed has great oversight over the Dodd-Frank suite of rules that came in after the GFC. There is some money that's being lent and being paid back that's not in here, but I don't know what the percentage is. But this is more than enough to indicate what the monetary stance is. As I go with that, I then can flip this into an annual or a cumulative. And here I'm looking at the monetary impulse. This is this part right here, this tail up here.
Got it.
And this is since COVID. And the Fed responds, encouraging bank lending, supporting bank lending at a 500 billion annual or 500 billion cumulative effect. And then, yes, the Fed did tighten up a bit. Maybe more was the concerns of the banking system. But then throughout this great ruckus that the Fed's tightening now, we're going to beat inflation, we're warning you about this. You can see that the actual actions were just the opposite. So from February or say January of 2022, the banks were clearly in an ease mode, going from a negative 1 trillion a year to approaching flatline. And then since Silicon Valley, I think is a good marker, or First Republic, they've done nothing. So there is no monetary policy in terms of any sort of metrics that I can identify that would be responding to monetary policy if it existed. There's
right.
So in a
normal world of like a Taylor rule type model, the instant reaction, you would assume that we would see a more significant change in loan growth activity here?
Yes. First, it'd be easier to pick it up in M2, but we can't use M2. But let's say the loan growth, if the Taylor rule said, "Holy cow, the wheels have fallen off," then the Taylor rule would have put a Fed funds to, theoretically probably well through -3 or something like that.
Right.
So that it has a problem with zero lower bound, and we would see this probably soar quite a lot,
right.
Up to 2.5, and then once the Fed responds to like inflation, which started in, of course, 2021, we would see it drop very, very, significantly more down to, probably 2 trillion, and then back up again if they so wanted, or probably staying down here. And it would definitely be no question that given the loan growth and decline, the Fed is easing or tightening, and there's no debate. And it's sudden. There is no lag. There's no cumulative, certainly. And it's obvious that nobody could argue that the Fed's not doing their job. There is monetary policy.
Hey, everyone. This episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. Meet your secure, reliable, institutional crypto partner, Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the full suite of tools you and your organization need to trade and manage crypto at scale. But it's more than just powerful products. It's about enabling you to build and grow your crypto practice via deep liquidity, industry-leading security, and white glove service. Think 24/7 support from an award-winning account management team and expert guidance through your institutional crypto journey, from onboarding to product demos and more. Experience it for yourself. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. So, just to have a tangible example, obviously we had the FOMC meeting yesterday and they cut the federal funds rate by 25 basis points. But the assertion is that because that cut has been priced into the forward curve for so long, it doesn't have the punch anymore. Is that basically what's going on?
Yeah, I think I look at Fed funds forwards as basically part of forward guidance.
Right.
It's part and parcel of the dot plot, and so I don't think it's useful in terms of indicative of Fed policy, and I don't think it's useful in terms of the economy. What I would look at is that the Fed the Fed doesn't exist as far as monetary policy. I think I've there's much more I could go into, but I think it's obvious based upon what I'm showing.
Mm-hmm.
So unless the Fed upchucks Wicksell and fires like 3/4 of the the staff of economists on the board of governors now, and replaces Williams out of turfs him out of the New York Fed, et cetera, et cetera, et cetera. It's going to carry on. I don't really see any ability of the Fed to return to a Fisher-based rule implemented with the reaction function. So I'm going to continue saying cheekily, there's no Fed, and I think sentiment does matter. I mean, the Fed has done just a stellar job. I think if Biden had hired Michelle Smith to run his campaign, he'd be president now.
Right.
Like they are absolute masters of propaganda.
Yeah. And that's the Fed meme you talk about, right? Is that, they do have a psychological impact on asset prices, but not a fundamental economic one.
They have no economic impact, but they have a tremendous impact on asset prices because asset prices are still following the MEM.
Right.
And it's believed. There's still I think an uncritical amount of attention to the FOMC when basically people should just yawn and, what happened today? It's really nonsensical how much attention and control the Fed's getting from a monetary economist or macroeconomist point of view.
So with the absence of no monetary, I want to shift into the fiscal side. So what is actually driving the economy at this juncture?
If this were all to be happening in, like, say, during the 2008 to 2009 to 2020, or even prior for the last 10 decades, big debate, if they're doing this or doing that. Congress was limited by the mandatory discretionary rule base. That means that, if the Democrats get into power, they can't go crazy and just give a chicken to every pot. And vice versa, the Republicans can't go crazy and just do armaments or something. So there's mandatory discretionary rules. So that capped fiscal to like about $1 trillion cumulative if that were in place in 2020. But Biden just went, boom. We're in an existentialist threat. Congress agreed. They got scared out of their wits. Maybe correctly, I don't think so, but they got scared out of their wits and they said, Biden, save us. And he says, anything we can do, we will spend. And that's what he did. So this cumulative fiscal spend, this is an annual roll. This is like starting with March of 2020, peaked at $3.5 trillion cumulative by the time of first quarter of 2022. But the actual gross spend was about 7.5 trillion. It was it definitely was a war footing type spend. Now, as that spend came through, it sparked a fairly brisk economy, which also we can look at, which raised a lot of tax. So the net was a lot less than the actual drama in terms of macro or certainly monetary viewpoint would have. The other thing, too, is the spend went to the lower cohorts, the lower 25%, the lower 50% income.
Yeah. And they have a huge marginal propensity to consume versus.
Right. And the guys who had to pay the taxes were, of course, the 50% of all Americans don't pay any taxes.
Hmm.
So the guys who paid the taxes and dropped this down to 3.5, or the upper cohorts of income and wealth. This was also one of the largest wealth redistributions that America's ever had, which isn't really commented on that much. At least I haven't heard it. So there is, behind this sort of like seemingly quiet and orderly progression, there's huge turmoil and flows caused by this fiscal shock spend that's really not, I don't think, really reflected in here as it should be. But anyway, there it goes. It causes a tremendous inflation, but it also caused tremendous wage growth, so that anybody saying, "Oh, even Trump, you're worse off now because of the wage inflation," is really full of it. That goes back to my quip that if Michelle Smith was handling Biden, reelection, she would have pointed out that, hey, you are making more money than you've ever made. So yeah,
Right.
coffee costs more, but you're much better off than you were. So anyway, this fiscal spend carries on. And what I think the story is that it dips in 2022, going into fourth quarter. And that's because of all the federal funded unemployment insurance, ACTS programs, CARES, various other programs ended. But this is also where the Inflation Reduction Act, CHIPS Act, all sorts of industrial policy actions. Biden sort of using this really, he's still free of mandatory discretionary rules. Congress is in turmoil. So that was able to get it back to this maintenance of just, between 3.25 trillion to 3.5 trillion. And it's actually been growing. It actually had a spurt up in second quarter of this year, and it's starting to fall back, but you can see that
Hmm.
it's still maintaining this 3.5 trillion. It's a big fiscal ad.
Yeah, that's primarily what has been driving this impulse,
Yeah,
correct? Yeah,
yeah.
got it.
And what it ends up being is just we're in a moonshot in terms of NGDP growth. And it's sort of baffling why anybody was looking for the recession. I actually know why. There's a lot of people why they made the mistake,
Yeah.
but it's certainly not. It wasn't their finest moment to keep calling for a recession. Some people are still calling for a recession when this NGDP is just on a moonshot.
Yeah.
You see
Yeah.
this, of course, in more liquid assets like Bitcoin. There you go,
Yeah.
Felix. I said something about Bitcoin, uh, and and certainly the
Yeah.
equity markets and all. It's
Yeah.
it's just off.
And so basically, like, just so that people can have a comparative idea, is that if we were in a normal Taylor rule type world, that would have got picked up in the Taylor rule and the Fed would have had a natural reaction function. But in the absence of that, we're just seeing like this reflexive loop in NGDP, right?
Yeah, that's right. And now the Taylor rule and monetary policy prior to the 2014-15 never responded to NGDP. They never said, "Oh, growth is too much.
Hmm.
Let's spoil the party." They would be responding to inflation. That part of NGDP that's inflation. They're actually joyful over real GDP.
Yeah.
So this is necessarily not what the rule is. But if you put it all together, this is the monetary, which I pointed out in the first slide, basically flat line. And now I've moved it to rolling annual. Okay, so we have a basis with zero set at the start of COVID. This is are not rolling annual. I'm sorry, this is still cumulative. This is fiscal, the blue line going up to 3.5. This is the total. If we add fiscal and monetary, and it's sort of startling. You can see there's no offset from monetary to fiscal. It's
Hmm.
it's the total is just still very strong, and if, in
Yeah.
fact, by the time we get into 2023, it's non-existent.
Yeah.
There is
So
no
you can
monetary
see in that
anymore.
red line there was a small amount of tightening from the Fed because I don't know, my assumption is because they were surprising with 75 bips hikes that had a reactionary effect. But again, like you show, it's not that much and it was offset by the fiscal. And now we're in this realm where monetary is basically like flat and despondent and it's just fiscal running the show.
That's right, and I would even I have this orange line just sort of a tool for myself. This is what I call NGDP innate. I'm probably mislabeling it, but this is what NGDP would have done if there was no fiscal and no monetary.
Ah,
They're both
got it.
zero. So yeah, we got whacked with COVID, and thank goodness for the fiscal.
Hmm.
This is a big hit for this would be approaching 10%
Yeah.
decline in GDP. But ever since then, as the various impulses stabilize and really sort of flatline, NGDP is just on a roll still. So there's obviously something more beyond fiscal and monetary that's now running NGDP. I like to call it innate. I'm all for anybody, sending me a message on Twitter telling me what the right name is for it. But this is very interesting. This is signs that not only do we have an unusual technical growth in the economy, but we now have one of the largest innate, natural, organic economic growth that the U.S. has had since World War II.
Putting that all together, you've had this framework where, yeah, you've been correctly fading recessions. You've been talking about like a huge, GDP boom, which has been correct. But the next phase is thinking about how that gets reflected in asset prices. But then also, you bring up the Minsky cycle and a potential Minsky moment. So
Sure.
I would just love to hear you break down what are the implications of an absent Fed in light of one of the largest innate NGDP booms we've seen since the 40s. Yeah, where does that all lead?
Okay, well, I want to keep, beating the dead horse of like showing
Yeah.
how there's no monetary policy, but we can go back to that if you want. But this is rolling annual NGDP change. And if we were to stretch this right back, this is level, not percentage. But if we were to stretch this right back to like, I don't know, World War II, we really would see this slowly declining just because of the effect of inflation. It's not current dollars. But you can see this would be a standout in any case. It's
Mhm.
really unusual. So this NGP rising hard without this governance of a Taylor rule,
Yeah.
or any sort of approach that you want to put into it, means that there's no mean reversion anymore
Mhm.
of to what a sensible policy would be to the norm. There's just a party, and we've actually entered. I quip. I like to use that scene of that sort of schlocky movie Babylon, where they had the elephant coming into the room and everyone's dancing away and everything. That's where we are now.
Yeah.
So if there's nobody taking, as Martin said in the '60s, nobody's taking the punch bowl away
Right. Yeah.
before Uncle Fester puts the lampshade on and starts hanging from the chandeliers. Everything that we're getting in excess of the potential of the United States will come off. And the way that happens is if there's no sort of like standardized way of inserting this control with the no Fed, is the way this happens is that we end up with greed taking place. I mean, why not? I mean, hell, it's the S&P's up to 6,000. A few people got it.
Yeah.
You start going to cocktail parties, and your dentist is giving you a bad time about how you missed it all, and he believes in Trump and knew it was going to happen. So you start to go in, and then people eventually put as much money as they can, and so then they have to put leverage in,
Mhm.
and leverage might be a second mortgage. Maybe you don't pay down your mortgage, or maybe you buy your house, even though you might have wealth. You buy your house on a mortgage thing for the tax effect, and also just to have money to put into the stock market. Everyone starts
Right.
doing stocks. It gets giddy. And then you get private sector loan growth. The hedge funds are already lending money to corporates. Uh, Growth that's outside the, um, the system. And as that growth takes place, it starts building a layer cake of where you get to the point where there's such giddy optimism in terms of the assets. We're now in a mania that you start to have to finance past paybacks of previous financing. And that, of course, that's what Minsky called the Ponzi stage. He did not call a Ponzi stage based upon the assets going up and up in some sort of hokum. He called the Ponzi stage in terms of like this layer cake of unwarranted, unstable debt, and that is what it is. That's why Minsky called it the instability. His theory is because it's out of the bailiwick of the Fed, it's out of the bailiwick of common sense, it's all emotion, and you just need one. I don't know, the hedge fund in Milwaukee fails because of their private
Right.
equity loans, and everything just gets called. It's outside of any sort of FDIC or Fed or even the government, so it just craters. Now, when the Minsky moment comes, we have the end of this Ponzi stage, and we revert back to what's called the hedge stage. And it makes sense to me that we will return to the hedge stage. where nobody takes any risk, that probably means that the markets will lose double of what they gained from when the speculative stage and the Minsky stage started. Very grim talk.
Mm.
And
Hmm.
it's sort of fun
Yeah.
to say, well, that's COVID lows, 2280. It gets
Yeah.
people's attention.
Yeah.
I don't really know where it is, but it's a hell of a lot lower than where we saw us in 21.
Yeah. So where do you think in that Misty cycle we're at right now? You think we're like still in the speculative phase? We're kind of moving into that Ponzi stage? Because when I look at like, say, I don't know, household balance sheets, they're not that levered yet. So do you feel like we're in the early stages right now?
This is S&P 500 to corporate profits. I still think we're really probably solidly in the speculative stage. People are starting to use leverage, starting to assume risk. We're well off the lows of S&P 500 to. I like to use the corporate profits as the main indicator of progress in the economy. And these are the BEA, the government's analysts' idea of corporate profits. You have to net out profits for federal banks, Federal Reserve banks. I don't know why they're in there. So unlike S&P earnings, stated earnings, and other things, this is the corporate profits for the entire nation.
Mm-hmm.
And you can see that people were really not a great believer in the move up in 2021, and then as we started they actually, I'm sorry, they were, but as they started to they still wanted some of the good times, so that when the Fed says, "Oh, we're going to tighten," and Jamie Dimon says we're going to go into recession and various things, the first quarter of 22,
Mm-hmm.
it does still hang in there right till the beginning of 22, but then it just gets kiboshed. Fed says we are going to raise unemployment and stuff. But since then, as I think people, perhaps not with the analysis I put forward, but they're starting to question, like, hold on a second, this economy keeps going up. My
Yeah.
neighbors didn't lose their job.
Yeah.
I'm still doing okay.
Yeah.
I
And
don't
like you
think
showed
times are
above
that.
that,
Yeah,
that heat map of jobless claims is really fantastic for showing that. Like we've been fine.
yeah. It's not just sort of we questionably fine. It's how it's possible to even say otherwise. Yet, of
Yeah.
course, many people are saying that. Well, not only are we in a recession as per labor, but it happened last year. I think that's baffling. Why anybody who claims to have any capability says that sort of
Yeah.
thing. This is jobless claims adjusted for the growth in labor force, so that I can have sort of a
Mm.
apples to apples comparison over time. This is so adjusted. The recent one was 127,000 jobless claims, well below the 220 odd that was reported. But the reason I do that is that then you can just slide along this column, this row, and you can see that it's pretty impressive. Like, it's not that all 44th week lines up,
Mm-hmm.
but you can definitely like look at the one above and one below. You can see that we're in something very unusual right now,
Yeah.
and it's indicative of great strength. It's also proof that here in 22, this is when the Fed says we're going to tighten and raise unemployment. They, I don't
Yeah.
know.
Yeah. Yeah. Okay. So I feel like the last big piece of this puzzle is, again, we're getting at this idea that there's some people that were calling for a recession. I felt like so much of that was baked into what they're seeing with the yield curve inversion that we are seeing.
Mhm, mhm.
You've had some interesting analysis in there on why that was incorrect. And I believe that's, earlier in the show, you mentioned that you understand why people were calling incorrectly for a recession. So could you just explain that aspect of what happened with the yield curve? Why did it send these false signals, and how does it play into this broader thesis that you've shown?
I start to wonder, like, how the hell, I was fully, having traded U.S. Treasuries in depth for 30 years. I was all sold on the idea that the yield curve is a very powerful, if not the indicator of what's going to happen in the economy.
Hmm.
So I was very confused through 22, and it started in Jan 22, that, well, as we carry on with the inverted yield curve, which was obvious if you look at the U.S. Treasury market rates, then why the hell is this economy not slowing? Why is this economy keeps going from highs to highs to highs? This was basically because the twos to fives are pretty well much what you you would think that what I would call the risk-free rate should be. There's no argument in it. But the 10 years, so maybe starting in the 5-year, but getting ever more torqued out to the 10 years, was not trading as per the risk-free rate because it resulted in the very well-known yield curve that was inverted. And this started in Jan of 2022. This is where Anna Wong and Bloomberg, actually every economist that I'm aware of, started to say, "Oh, I'm a smart guy. I really know my stuff. So I'm going to take a jump," and they were able to jump ahead by maybe days, but no more. That as soon as this thing inverted, we're going to have a recession.
Right.
And then they got even more excited and more affirmed in their view by the third quarter of 2022. And then they started talking, well, it's because the Fed has legs. Powell himself in front of Congress says, well, it's because the cumulative hasn't kicked in. But it will. For sure, this is the right anticipation for what we will do to the economy. And then you can see by 2023 of 09, the market rate treasuries started to disinvert, I guess the best way to call it, although it dabbled with reversion, and then it's gone positive since the second quarter of 24. This still doesn't explain the growth that we've experienced since 2021. It's nonsensical. So perhaps it takes a naive person like me to say, well, then it must not be the curve.
Right.
It takes sort of like a fool to see the reality. So I said, well, what we got to do is cast around and what is the curve? And then what I came to the conclusion of was that the U.S. Treasury, or excuse me, not U.S. Treasury, U.S. mortgage rates, 30 years, if they are can be used into mortgage-backed securities that become issued by the GSEs, government-sponsored enterprises, Fannie Mae, Freddie Mac, so on, or even the Fed considers them, they're risk-free in terms of corpus, and until they're prepaid or default, their interest is also risk-free too. So there's a little hair in there in terms of like what the actual maturity is of these mortgages. It's also monthly, but it is risk-free. So the risk-free, the conventional mortgage rate, and you can just eyeball that since I take this back to 89, it traded pretty well in lockstep with U.S. Treasuries, especially if you took a reasonable idea of how much the prepayment option is worth that every mortgage holder earns, how much it costs to put it into a mortgage-backed security. You would end up with the 10-year U.S. Treasury rate. Now, this is bootstrapping. I'm not saying they're one and the same. I'm just saying that they had the same rate. Again, it's because of tax policy for how your mortgage income, or excuse me, interest. Also, the fact that you have these agencies, because of policy, are rubber stamping them. They're risk free. But from January of 2022, and it's not quite apparent here as it seems, but you can see that the U.S. Treasury 10-year goes up, but the the 30-year mortgage rate goes up a hell of a lot more. And then this spread, which many people comment, well, they have a whole bunch of gobbledygook in terms of what explains it, volatility, prepayment, and people with sort of like some half-baked knowledge of mortgage industry say, well, we know the U.S. Treasury 10-year is the risk-free rate, so there must be a problem with mortgage rates, not a problem with U.S. Treasury rates. So they're sort of go with the flow, and also what their habit that has been formed for about 30 odd years, ever since mortgages were created, and not look at the reality. And I guess I'm stubborn enough, or maybe not as educated enough to say, no, this isn't real. It's just not happening. So what I do is I take the U.S. Treasury market rate, and I solve using a bootstrap mortgage 30-year, and I come up with a risk-free rate. Now, if I were to extend this back to late 80s, it would be much the same, except for the odd times when there's a conniption problem where the risk-free nature of the GSEs is challenged, or they think everyone's going to enter default and prepayments and it's just soar. And yeah, it does it does, as per bootstrapped off the mortgage rate, it does trade below U.S. Treasuries, but it comes right back. And this has been the case if you went back for quite a long time. But from January 2022, it never corrected. It just got wider and wider to the point where it's starting to close, but the risk-free rate is not the U.S. Treasury 10-year market rate. Now, why is this important? It's important because that if you use the risk-free rate, then you're now in sync with what has actually happened with GDP,
which is that we never inverted.
Right, it never inverted, and it really inverts. It inverted a bit in the GFC, maybe a couple of points depending on what sort of fix you did. But you can use the U.S. Treasury 10-year to 2 years as the actual rate. Maybe they're the .com, they got a little over pessimistic, but it was, you're safe to use one in the U.S. Treasury market rates as the indicative of the curve. But from January of 2022, there's obviously a great divergence, which we've never experienced, between market rate and U.S. And the U.S. risk-free rate as bootstrapped with the mortgage rate. Now, I'm sure there's better ways to bootstrap it out. I've tried various. I ended up using various casting forward the Fed funds rate under sort of a fishery idea. I can get into that a little bit and so on, but I'm pretty confident that I'm within 20 basis points of reality.
Right.
So
right.
This means that everyone blew it because they're looking at the yield curve.
Yeah, interesting. So, okay, just as we wrap into a conclusion here on everything, I want to finalize everything that we just talked about. So basically, when you get down to the first principles of the economic data, this idea that's been floated around the last few years that we're in a weird economic cycle, that it doesn't make sense. It actually does make plenty of sense when you understand the fundamental causal factors that we just went through. And based on that, we're right on track where we are. So, maybe just to wrap up with those final thoughts, like obviously you mentioned that we're heading into this more speculative phase of the Minsky cycle, but where do you see us going for the next couple of years from here on?
I don't like to use time as my x-axis in analysis, both in thought and also in the charts. I think time is elastic. Like sometimes you have a week of events, like for example the election, which are basically like 3 months of change. Sometimes it takes 3 months of change to even get a day of change. If I'm not sounding too at the lunch here.
Yeah.
But so to say like the timing is you're almost insisting that I read a fiction for you, but
fair enough.
But there's good novels and shitty novels, so I will extend. And I would say that if, and I have a hard time getting metrics, but if you watch private sector debt growth and say it's at X and it's been trending at certain X for like the last 10 years or so. And again, I have trouble finding a metric to do this. The ECB puts out some metrics, but it's quarter to quarter, and it's not generally for the US. It's probably in the inner sanctum of guys who, do private equity, they probably have this number. But if that starts to grow at like X plus 10% or 20% over trend or 30%, but it's a clear sign that excessive private sector debt growth is happening, then you also know that instability is happening. Now, that'd be the easy way to do it if you actually had that metric. And probably the effective way. What I would say, and I'm just sort of writing a good story, but I think it's not a bad story, is that I think Trump will get completely entrenched. I think his tariffs are going to be great for the U.S. economy. There's going to be another boost. If he does a Michael Pettis type of taxation on purchases of U.S. Treasuries by the likes of China, there'll be another boost to the U.S. economy. If he just strong arms the Fed, probably fires Powell, and the Fed does go. That was baloney, by the way. That Powell says you can't be fired by law. It's bullshit.
Yeah, I saw your tweet that Congress, and Congress is full red. They can change. They can decide.
Yeah, God knows what lunacy they're going to do, but it's going to be
Right.
interesting. But first, crypto's got to become totally legit. Off we go with crypto. So I would think once this all gets instituted and everyone completely gives up on the Fed,
Yeah.
and Congress is not, nobody's governing this private sector debt growth, and the stock market starts reflecting extraordinary heights. Maybe we return back to the Fab Five. Maybe S&P starts to, people start saying 7,000. 6,000 was pretty crazy talk a year ago,
Yeah.
but it wasn't crazy if you looked at the economy.
Yeah, and we just hit it. I had a look at the S&P just hit 6,000. So hats
Did
off
it
to you on
today?
that one. Yeah, just now.
I was too busy getting my pitch book for you here.
So
How
yeah,
about that?
hats off on that call.
Okay, so what's my next act?
Yeah.
What do you now? So I think if we enter a mania, and it will be a mania, people start. Well, first, some people are already saying 6,200, 6,300, 6,500, but I think a mania means like 7,000 plus some unmentionable number now, out of control. And then if the debt creation is layer caked up and it gets ever higher, well, it's a layer cake with double the meringue between each layer, so it's very unstable. And if it topples, then I sort of pity Trump in terms of best laid plans, because he probably wants to get into be a good guy for a legacy and give some future for kids and all that. And I think this could just undo him.
Yeah, makes sense. Well, look, George, I think we made some really good progress on getting your ideas across. Really enjoyed that. Where can folks go if they want to hear more about your work?
I have a Substack, The Monetary Frontier, .substack or something. I go out of my way to, maybe it was a mistake because I think people mistake it for low quality. Maybe I should charge $50 a month, but I only charge like $10 a month for it. And I try to do the best job I do to keep razzle dazzle out of it and just talk to what knowledge I have. And then also for fun, I'm at Bickering Brattle. Bickering Brattle is a wee little mousy poem, rather than some of the words I'd use. But at Bickering Brattle, also the name George Robertson. I decided to come out of the closet and come there.
Perfect.
And I would love to be followed, and also I also love criticism. The problem I have, although I'm not quite as alone as I used to be, is that people just he's a nut, dismiss me, and I'm just battling to myself. And I would love good criticism. I know there's a lot of people out there better skilled than I am in these topics, and I love them to come back and say, but have you thought of this or have you thought of that, and have a debate. I promise to be much more polite than I've been in the past, and I'm really a nice guy. And I'll even, if anyone wants to interact with me, they're in New York, they're useful for me. I'll, even if they say I'm totally out to lunch, but they show why, I'll buy them a beer or two. So there you go.
Fair enough. I appreciate it, and I appreciate you coming on the show. That was great. Thanks, George.
Okay, good stuff. I hope it was useful.